Stop chasing red candles. While 90% of retail traders are panic selling into this drop, the institutions are simply waiting for their liquidity to hit. Welcome to the dark side of gold trading, where we don't predict the market, we track the money. Watch this zone closely on the 5-minute chart. You see a breakdown, the algorithm sees a trap. This green zone isn't just support, it's an institutional order block. Banks induce sellers to break the low, grabbing their liquidity to fill massive buy orders. Once that trap signal prints, we aren't guessing. We place our entry, set a tight stop below the liquidity grab, and target the imbalance above. This is high-precision scalping. Notice the 15-minute chart. This is our anchor. We switch here immediately to ensure we aren't catching a falling knife. We need to see that the structure holds up on a higher time frame. If the 15-minute trend is still bullish, that drop is just a discount, not a crash. Then, I switch to the 1-minute chart. Then, the 3-minute chart. This is crucial. The 1-minute can be too noisy, and the 5-minute can be too slow. The 3-minute is the perfect middle ground. It filters out the fakeouts of the 1-minute timeframe but confirms the reversal faster than the 5-minute. Once all three align, 15M for trend, 1M for entry, and 3M for confirmation, the probability of winning skyrockets. And 1-hour charts. We aren't just blindly buying a dip, we are aligning with a bullish higher timeframe trend. The algorithm confirms our bias with green trend bands. When the 1-hour trend says up, we ignore the short-term noise and only hunt for these long setups. This is the secret sauce, the daily timeframe. Look at this massive breakout long signal. Institutional moves take days, sometimes weeks, to play out. By checking the daily, we know the smart money is heavily net long. This gives us the confidence to hold our intraday winners longer, transforming a small scalp into a massive swing trade. We are swimming with the whale, not against it. Now, at 2 minutes and 19 seconds, we leave the retail noise behind. We switch to the daily timeframe. This is the playground of the banks. You see, an algorithm on the 1-minute chart can make you money, but the daily chart builds empires. Notice the signal here, breakout long. This isn't just a signal, it's a declaration of intent from the smart money. When the daily says bullish, every short position on the lower timeframes is essentially suicide. Retail traders are trying to short the top, thinking the price is too high. But institutions don't care about high. They care about liquidity. They are pushing this price up to grab the stop losses of early sellers. We call this the retail trap. While you are looking for a reversal, the banks are using your stop loss as fuel to push the price to new highs. We only trade in the direction of this green band. I want you to understand the psychology behind the movement. Watch closely as I map this out. The market moves in a specific cycle, it's a language. First, we establish a top. This is where retail thinks resistance is. Then, we see the trap. The price pushes just above that top. Why? To trigger the breakout buyers and stop out the early sellers. But what happens next? The retest. The price comes back down. This isn't a reversal, it's a confirmation. The banks are testing if there are any sellers left. If the answer is no, we launch. Top, trap, retest. Memorize this sequence. Trading isn't about being right, it's about risk to reward. Look at this area I'm marking. This is the low risk zone. Why? Because your stop loss is protected by the institutional order block, that green wall you see. If the price breaks that wall, the trade is invalid anyway. But the high reward? It's infinite. We are targeting the moon target above. You are risking $1 to make $5, $10, or $20. That is how banks survive decades in this game, while retail traders blow accounts in weeks. Now, this is the hard part. The waiting. On a 14-minute video, this looks fast. In reality, this setup on the daily chart might take days to develop. Banks are patient accumulators. They don't chase candles, they let the price come to them. Notice how the candle respects our levels? It touches the zone and rejects. That rejection is the algo telling us, we are defending this price. If you enter before that confirmation, you are gambling. We wait for the close. Now that we have our daily bias, we know the banks are long, we can go back to our 5-minute or 15-minute chart. Remember that trap we saw earlier? Now it makes sense. That 5-minute trap was just a fractal of the daily breakout. We used the 5-minute chart to find the entry, but we used the daily chart to hold the trade. We are scalping with the precision of a robot, but holding with the conviction of a bank. Pay close attention to what I'm drawing here. This isn't just lines on a screen, this is the heartbeat of the market. First, the market creates a top. Then, look at the move up. The trap. The banks push the price past the top. Why? To clear the liquidity. They take out the stops and trap the breakout buyers who think the market is going to the moon. But watch the retest. The price drops back down, tests the level, and then the real move happens. If you don't understand this top trap retest cycle, you are just liquidity for the algorithm. Now, I am marking the low risk zone. This is the only place you should be interested in. Most traders try to guess the top, that is high risk. Others chase the breakout, that is suicide. The professional waits for the retest. Entering here means your stop loss is tight, right above the structure, but your potential reward is massive. You are risking 1% to make 10%. This is how you grow a small account, patience and precision in the low risk zone. Again top, again bottom. This pattern isn't a one-time event. It happens on the 5-minute, the 15-minute, and the daily. It happens in the morning session, and it happens in the New York session. I'm writing real-time because you need to train your eyes to see this live. Hindsight is easy, but in real time, you need to recognize when the bottom is being formed and when the top is being trapped. The market is a machine that repeats the same cycle over and over again. Why did I write that? Because the retail sentiment is screaming buy, but the structure is broken. We are at a resistance level where the trap has already happened. Buying here is donating money to the banks. I wrote only ready for short because the setup has shifted. We are no longer looking for continuation, we are hunting the reversal. You must have the discipline to sit on your hands and say no to the bad trades. I'm noting down the psychology of the institution here. Banks try to up. They push the price up not because they want to go long, but because they need to sell at a better price. They need buyers to sell to. So when you see that aggressive green candle pushing up into resistance, don't get excited. That is the bank markup before the markdown. They are filling their sell orders. Don't be the buyer they are selling to. You can spend years learning to spot these traps manually, or you can let the algorithm do it for you instantly. The QuantFlow Algo, institutional trap and reversal doesn't just guess, it detects the exact moment banks are trapping retail traders. It paints the order blocks, marks the traps, and signals the reversals automatically on your chart. Stop trading against the algorithm and start trading with one. Click the link in the description to get QuantFlow Algo today.